Well, let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, more records overnight on Wall Street. Is this all about that anticipation from the Fed?
Well, I mean, I wouldn't say in the equity markets that's the case. I think it's just pure momentum. Tesla had a good run. People got very excited about Musk's additional 2.56 million shares he purchased. That sort of dissipated when everyone realised that, he owned 500 million shares already. But stock was up 3.5%. Alphabet was a juggernaut, and most of the gains really came from the Mag 7. I would probably argue that if you want to look at positioning around the Fed, it probably was seen more clearly in the US Treasury market, in the rates market, and also in US dollars. And then gold had a nice rally on the back of that dynamic. But I think the equity market, very concentrated breadth to Mag 7. 40% of stocks were higher on the S&P. But I think that's just a continuation of what we're seeing there. But clearly in the rate story, I think there's an interesting dynamic that's shaping up that really spilt over into broad US dollar weakness overnight.
Yeah, interesting you point out that concentration. So that narrow leadership continuing, obviously, as investors rotate into those outperforming and mega cap tech stocks.
Yeah, I think one of the signs of a healthy bull market is that we have seen quite active rotation. You've seen AI stocks, semis doing really well. Then, a couple of sessions later, you see a bit of a move in value areas of the market, and people are switching in terms of styles and factors. And that's usually a sign of a pretty healthy market, and that sort of mitigates this idea of concentrated breadth. But right now, what we've seen overnight was that Google or Alphabet is in absolute beast mode at the moment. We've seen a more favourable regulatory environment for them, but also their sort of play into the AI scene as well, and maybe cutting a little bit of Nvidia's lunch, their TPUs, so to speak. Is working quite nicely for them. I mean, Nvidia itself had a few headwinds from, sort of headlines around China and the US, and that seems to be a bit of a political hot potato at the moment. But I think, the sign of a healthy bull market is that one sector gets too hot, we see rotation into financials, value areas of the market, and then it's sort of, semis continue to boost along. So momentum very much the name of the game. But, the Nasdaq's up for 9 days in a row now. So I'm sure a few people will say, well, it's probably a little bit too hot. But, if you look over the trend since, go back to 2008, for example, when we've seen, the Nasdaq rally 9 days in a row, or 8, 9, 10 days in a row, typically that sort of leads to further gains, because it's a sign of real momentum in the market, and that has sort of given forward pricing the idea that 10, 20 days later, the market is typically higher in that situation, probably nearly 2/3 of the time in the occurrences we've seen, the market trades higher. So momentum favours the brave. We're at all these levels for a certain reason, and the bulls are very much in control at the moment.
Yet, Chris, what do you see as the potential risk that could trigger a pullback?
Well, there's a whole laundry list of factors, but a couple that I'm really looking at. I think we're looking at the funding markets in the US. They are the first derivative of what everything's built on in the financial market, and we're talking about repo, we're talking about SOFR, we're talking about US T-bills, and they sort of feed into this SOFR rate. And SOFR now is trading above what the Fed pay on interest on reserve balances with the banks. Now those reserves have been falling pretty sharply because there's the process of the Treasury General Account rebuild is well underway. We're probably going to see the number of tax receipts, because it was tax season yesterday in the US, and what that will do is that will see reserves from banks coming out of reserves held by the Fed going into the TGA, and those reserves falling are starting to worry a few people, because reserves are seen as system liquidity. We're at sort of $3.15 trillion at the moment. But, if you go below 3 trillion, you start questioning that ample reserves, and then maybe people talking about scarcity. And as I say, we're starting to see that in the funding markets with the SOFR rate trading above what the Fed really try and cap short-term money rates at. So there's a bit of dislocation, a bit of stress building in there. I think if that was to push to, say, 10 basis points, I think equity markets would take notice of that. What it definitely does, though, is it throws the idea that the Fed will have to end QT very, very soon, certainly by the end of the year, because they won't want to see that situation happen. The second factor, of course, is the big one, which will take some time to permutate, and that is, what we're seeing on the consumer side in the US. We're seeing real incomes falling reasonably sharply. Consumers and households are saying that inflation is a real concern for them, and it's going to outpace wages going forward. And so I think that if we are going to see markets really ramp up the idea about a recession, as I say, that's not going to happen overnight. It's going to take more data to come in. It's going to be a consumer behavioural-led recession fears, as opposed to what we're seeing on the business sector. The business sector is still doing quite nicely. PMIs and ISMs were still pretty strong, but it's the consumer I think we're watching. So retail sales tonight could be quite an interesting one. But I think if the market's going to have a 15%, 20% decline over a period of time, it has to probably come from something to do with the consumer shying away that leads into business retrenching, and that's not going to happen, as I say, overnight. But that would be the point where the Fed go, we're way behind the curve. We need to cut rates below the neutral rate of 3%, and we need to do it pretty quickly. And history has shown us when the Fed are chasing economics, the equity market doesn't really respond too positively. So I think that would be the big elephant in the room. But as I say, we're watching the consumer, we're watching behaviours, and obviously jobs are very much key to that.
Meanwhile, Chris, the pressure remaining on the US dollar, and as a consequence, we're seeing the Aussie continue to build.
Yeah, I mean, it's not really a function of the Australian dollar, although I will say that the fundamentals for the Australian dollar are pretty rosy at the moment on a comparative basis. We've got a strong political system compared to France and the US and Japan, and that lowers the risk premium in the currency. We've got a low government debt level as a deficit compared to a lot of other countries, which is pretty manageable. And we've got growth which is rising, and we're getting to potential. If you get anything above 1.8%, it starts to become inflationary. So I think relative growth, relative rates, political stability, all favour the Australian dollar, and China equity is flying at the moment. So that's a big positive. But it's a broad US dollar weakness story playing through, and I think that's an interesting dynamic, because a lot of people, including myself at the beginning of the week, was saying, well, we've got so much being priced across the US swaps curve in terms of expectations for cumulative cuts going forward, that it staggers to belief that we're going to see the Fed outdove that market pricing. So maybe there's a bit of upside risks on a skew basis for the US dollar. But look, the way it's been trading overnight, the dollar index is falling, euro dollar's pushing recent highs, Aussie's moving up. Some of the LATAM currencies are looking pretty good versus the US dollar. The market has very little concern about holding those US dollar shorts going into there. And I think that's just the belief that the Fed are progressively looking behind the curve, maybe looking like they made a policy mistake, given what we saw from the inflation reports recently, and where we're modelling core PCE 0.2% month on month, which is pretty low. I think the idea is that the Fed are progressively behind the curve, something obviously that Trump's been pushing hard. So, the US dollar continues to go lower. That's probably putting some upside risk into the US equity market, certainly in the multinationals, but it's also obviously having a positive effect on the gold market as well.